A beginner's guide to IFRS. That is our lecture for today. Welcome. I am Kobe and I help people learn accounting standards in a clear, simple, and practical way. Let's get into our lesson. Imagine a world where every company prepared financial statements in their own unique way. One company records assets one way, another uses a different rule, and a third invents something entirely new. Investors, lenders, and even governments would be lost trying to compare financial reports. This is the problem international financial reporting standards solve to create one global accounting language. This is a foundation lecture before studying individual accounting standards. In this lesson, we shall discuss Introduction to IFRS, why they exist and why they matter, advantages and disadvantages of local adoption, the IASB and their role in standard setting, a list of all IFRS and IAS, and categorization of standards into classes like assets, equity and liabilities, financial instruments, performance and income, group accounting and disclosures for the road ahead. What is IFRS? The International Financial Reporting Standards are accounting rules and principles developed to ensure that financial statements are consistent, comparable, transparent, and understandable across countries. They are issued by the International Accounting Standards Board, the IASB. IFRS replaced the older International Accounting Standards, IAS, though many IAS are still in force today. Advantages and disadvantages of IFRS adoption. We begin with advantages. 1. Comparability. Investors and analysts of financial statements can make better comparisons between financial position, performance, and prospects of entities in different countries. 2. Transparency. IFRS improves trust and accountability. 3. Lower cost of capital. Access to international finance should be easier because banks and investors in international financial markets will find it easier to understand the financial information presented to them by entities who wish to raise funds. Efficiency. Multinational companies don't need to compare multiple sets of accounts. For international groups, harmonization will simplify the preparation of group accounts. If all entities are using the same framework for financial reporting, management should find it easier to monitor performance within the group. Disadvantages of IFRS adoption. 1. Cost of transition. Transitioning from local standards to IFRS comes with a lot of costs that may include training accountants, changing systems, and educating regulators. Complexity. Some IFRS rules are technical and challenging for local adoption. Cultural and legal differences. IFRS may not always fit perfectly with local laws, tax rules, or business culture. Cultural differences across the world may mean that one set of accounting standards will not be flexible enough to meet the needs of all users. Continuous change. Frequent updates mean constant learning and adjustments and additional training costs for businesses. List of accounting standards. There are two groups of accounting standards: the International Accounting Standards, IASs, and International Financial Reporting Standards, the IFRSs. The IASs are the older standards. Many are still effective, and some have been superseded by IFRS. The IFRSs are the newer accounting standards. This is the list of all the international financial reporting standards. Some have replaced some IASs, like IFRS 3, which replaced IAS 22, IFRS 9 replaced IAS 39, IFRS 15 replaced IAS 18 and IAS 11, IFRS 16 replaced IAS 17, IFRS 17, IFRS 17 replaced IFRS 4, IFRS 18 will replace IAS 1 and related parts of IAS 7 and IAS 8. This standard will be effective January 1, 2027. This is the list of all IASs. IAS 1 will be superseded in 2027 by IFRS 18. Categories of standards. To help us study systematically, we group the standards into clusters. These are the standards that fall under the asset cluster: IAS 2, IAS 16, IAS 36, IAS 38, IAS 40, IAS 41, IFRS 5, IFRS 6, and IFRS 16. Under the equity and liabilities cluster, we have these standards: IAS 19, IAS 33, IAS 37, IFRS 2, and IFRS 17. These standards deal with financial instruments: IAS 32, IFRS 7, and IFRS 9. Performance and income, we have these standards: IAS 1, IAS 7, IAS 8, IAS 10, IAS 12, IFRS 15, and IFRS 18. For group accounting and disclosures, IAS 24, IAS 27, IAS 28, IAS 34, IFRS 3, IFRS 10, IFRS 11, and IFRS 12. The last cluster focuses on specialized areas. We have IAS 20, IAS 21, IAS 23, IAS 26, IAS 29, IFRS 13, and IFRS 14. Lesson summary. IFRS mean common financial language for reporting. Adopting IFRS around the world enhances global comparability and trust in financial reports. Accounting standards are set by the International Accounting Standards Board. And then to help us study systematically, we grouped the standards into clusters: assets, equity and liabilities, financial instruments, performance and income, group accounting and disclosures, and specialized areas for the road ahead. IFRS is more than just accounting rules. It's a common financial language for the world. Understanding its background, advantages, disadvantages, and categories gives us the foundation we need before diving into the individual standards. In the next lessons, we will break them down one by one into simple, memorable learning blocks, beginning with the standards in the asset cluster. Our next lesson will cover IAS 16, property, plant, and equipment. See you in our next lesson.